Hey everyone, welcome to today's Explainer. We're going to tackle something we've all been hearing since we were kids, that saving money is a fantastic habit. But let's be real for a second. Can just stashing cash away actually multiply your wealth? Today, we're tossing emotions and hearsay completely out the window, and we're strictly focusing on pure math and hard facts. We're going to decode the exact mathematical framework of transitioning from a regular saver to a successful investor, with absolutely no fluff. So let's get right into it.
Okay, let's dive into this roadmap. First step, the savings illusion. Second, we'll look at the actual math of compounding. Third, overcoming that very real fear of investing. Fourth, a straightforward 5-step path. And finally, how to survive and actually thrive during market volatility. We're taking a super structured, logical approach here, so don't worry.
All right, starting right off with section 1, the savings illusion. Why exactly is just saving your money not enough?
Everyone tells you to save a piece of your income, right? But here's the harsh reality hiding behind that advice. Inflation and super low bank interest rates are literally eating away at your money's purchasing power every single day. Let's say you've got $10,000 sitting in the bank, earning an average 0.5% interest. After a whole year of waiting, you make $50. Yep, just $50. The math clearly proves that saving merely protects your money. It's just playing defense. If you actually want to grow it, mathematically speaking, you absolutely have to invest it.
Let's move to the next part and see how this builds. Section 2, the math of compounding.
$67,000. Now, this isn't some made-up number pulled out of thin air. This is a solid mathematical result based on historical data. If you take that same $10,000 and invest it in an index like the S&P 500, which has a historical average return of around 10%, in 20 years, that money balloons to $67,000. That is the sheer power of just putting your money in the right place with zero extra effort on your part.
And this brilliantly illustrates the real story. Let's compare those two figures. On one side, your 1% savings account crawls to just $12,200 after 20 long years. On the flip side, the 10% investment rockets up to $67,000 in the exact same timeframe. Both started with the exact same amount of cash, but the results, worlds apart. The biggest takeaway here is that the real wealth gap isn't between savers and spenders. It's between savers and investors. Moving to section 3, overcoming investing fear. Because if the math is this obvious, why isn't everyone doing it?
Well, it comes down to human psychology. Money in the bank feels safe because it's static. It doesn't randomly drop 5% on a Tuesday afternoon. Investing, however, comes with emotional roller coasters thanks to market fluctuations. The easiest, most effective way to crush this fear is to mentally split your money into two completely different buckets. Bucket 1 is your safety money. This stays static and is purely for emergencies. Bucket 2 is your growth money. This is the money you invest, fully expecting it to bounce around as it grows over time. When you mentally separate these two, you stop panic selling your shares the moment the market has a totally normal dip. Now for section 4, the 5-step path. Think of this as a safe, logical bridge to cross from just saving to actually investing. Now, what's really interesting about this is that there's no get-rich-quick nonsense here. It's just logic. Step 1. Before you even think about investing, build an emergency fund covering 3 to 6 months of living expenses, so you never have to sell your investments in a pinch. Step 2. Mentally separate that safety and gross money. Step 3. Start incredibly small. We're talking $50 or $100. Building the habit is way more important right now than timing the market. Step 4, keep it simple. And step 5, stay disciplined. Let's double-click on step 4 for a second. So many people think investing means staring at computer screens all day, day trading, or gambling on some wildly complicated crypto. But the facts show the exact opposite. Legendary investor Warren Buffett has said time and time again that for the vast majority of us, low-cost index funds are the smartest choice. They just track the whole stock market, instantly spreading your money across hundreds of companies, which automatically slashes your risk. If you think steadily investing small amounts sounds boring, just look at this math. If you consistently invest $300 a month, assuming a very standard 8% average return, in 25 years, you'll have around $285,000. But here's the absolute mind-blowing part. Only $90,000 of that came out of your pocket. The remaining $195,000 is pure, automated, compounded growth. That is literally your money working for you. To really lock in why discipline is crucial, picture this analogy. Saving your money is like storing seeds in a glass jar. Sure, they're perfectly protected, but they're never ever going to grow. Investing, on the other hand, is like planting those seeds in the soil. At first, pouring water on dirt just makes mud. It looks messy, you don't see immediate results. But if you have the discipline to endure that initial messiness, eventually you get a massive harvest. Finally, Section 5, Surviving Market Volatility. How do you handle the bumps in the road?
So, the crucial point is, what happens when the market crashes? It's the big question everyone asks, but you have to shift your perspective here. For a long-term investor, a market crash is not a disaster, it's a pure mathematical opportunity. Why? Because when prices drop, your fixed monthly investment suddenly buys way more shares of those same great companies at a massive discount. When the market inevitably recovers, all those extra shares drive incredible returns. That's exactly why experienced investors don't panic. They don't think in days, they think in decades. We've reached the end of today's explainer, and I want to leave you with one very provocative question. Saving money in the bank builds stability, and there's no doubt we all need that. But mathematically speaking, investing your money builds true financial freedom. The sooner you blend these two strategies, the more powerful your future becomes. So ask yourself today, are you just hoarding seeds in a jar, or are you finally getting ready to plant them in the soil? Hopefully these facts have given you a fresh perspective. Catch you next time.